All right, welcome to the Leslie E Lab. My name is Frank Rimalovski. I'm the Executive Director of the Entrepreneurial Insitute here at NYU. We run the Leslie E Lab and a whole host of other programs and resources to help students and faculty start startups. I'm also the Managing Director of the NYU Innovation Venture Fund, which I'll tell you a little bit more about at the end of the talk, but just preview. It's a seed stage or early stage venture fund that invests in startups founded by NYU students, faculty, and researchers. I've been investing in startups since 1998, both for a large company and a private venture fund, and for the last 7 years here at the university. And so what I want to talk about today is kind of one of the core elements of our Startup School series here, which we call When and How to Raise VC, or Venture Capital. And what I want you to walk away from this talk with is a better understanding of the business model of how venture capitalists operate and what they look for. Because one of the things, if you ever do raise venture capital, they're going to want to understand your business model. But just as much as they need to understand your business model, I think it's equally important that you understand their business model. What are their interests, their motivations, their interests? How do they make money? What are their incentives and all that good stuff? All right? Is that kind of why you're all here, what you signed up for? Good. All right. So the way we'll do this is first I want to talk about some of the different kinds of investors. And I'm talking about venture capital as a general category that, as we'll talk about, includes angels and seed funds and venture capital funds themselves. And we'll demystify some of that taxonomy. And then we'll also talk about how does venture capital work? What is that's the what is their business model part of that. And then we'll talk about what I call the VC math, which is really to help you understand how their business model impacts your business model, okay, or your economic model. And there won't be any heavy lifting here. You don't even need a calculator to be able to do this all in your head. So don't think I'm putting you to do any hard work. And then we're going to talk about when and how to look for venture capital, and I'll give you some tips along the way. So first off, I want to talk about the different types of venture investors. Before I even do that, though, I want to describe the definition of an investor here. And this is the dictionary definition of an investor. It says, one who expends money with the expectation of achieving a profit or material result by putting it into financial shares, schemes, shares, or property. Okay, so the reason why I'm putting this up here, while it might seem obvious, okay, it's really important to understand that investors are making an investment in you, not because they love you or believe you or because they like technology, but because they really need to and want to make money, okay? And so by giving you money, they're expecting to get something in return. And what they expect to get in return is a piece of your business, so that when your business becomes larger and grows, that actually they will make money, more money than they actually invested in you to get started, okay? Well, that might seem, like I said, really obvious. You'd be surprised how many people actually don't actually grok that. Okay, and they think that they can hold on or maintain 100% control of their company when they're getting money from other people. Okay, but you give and you get. Okay, I'm going to be sharing with you some myths about venture capital. Hopefully we'll bust those myths in the process. The first one is that venture capital is the primary funding source for startups. Actually, in terms of the amount of money that venture capital as a complete asset class puts into small businesses, it's about 1%. Okay, and even in the tech sector, it's in the low double digits of percentages. So there's lots of sources of capital out there for businesses to get started with. Venture capital is only one of them. Okay, for those of you who've attended any of the other startup school workshops, you might have heard us talk about some of these stages of venture growth, or as we call it here, the venture funding life cycle. Okay, these are the same 4 stages that we talk about in customer development, of discovery, validation, customer creation, and company building. I put this up here now not to give you a rehash on that, but rather to try to map how the different sources of funding out there map to the different stages of that venture life cycle. Okay, most people tend to think, if I have an idea and want to start a business, step one, raise venture capital. And actually, that's not the case. Okay, venture capital, both angels and certainly the larger funds, as we'll come to see, tend to happen over here. They like to fund businesses as they're beginning to scale. Okay, unless your last name is Zuckerberg or Musk, venture capitalists and angel investors don't want to fund your idea. Okay, and we can talk about that in Q&A if we have time about why that shift has happened, because 20 years ago that was the case. Okay, but today the barrier's been lowered through things like cloud computing and open source software and all this other stuff. And so they don't want to fund your business to find out if someone cares or not. Okay, they want to know that you validated that there's a demand for your product or service and that you can economically acquire customers and have demonstrated that there is a business there or that the dogs will eat the dog food. So if you're in this stage, you're in this discovery phase where you're testing your assumptions about your customer needs and problems, right? That's not venture capital land, okay? That's really when you should be thinking about grants, and competitions, and maybe the founders even putting some of their own money in. And I'm not encouraging you to max out your credit cards, but it is often what entrepreneurs do in the early stages of their business. Now, the good news is you usually don't need you almost never need millions of dollars to do this. This is sometimes costs next to nothing to go out and talk to customers. Okay, to understand their needs, to validate the problems that you're solving, to understand their preferences and priorities. Okay, that really shouldn't cost you much, if any, money. But there is money in the university, and we'll talk about resources available for that. Once you've validated the problem and now are ready to test your solution, okay, then there are other sources of capital out there. Most of those are non-dilutive, meaning that they don't require giving up ownership in your business to get there. So again, there's grants, crowdfunding, things like Kickstarter and Indiegogo and non-dilutive sources of crowdfunding are an increasingly popular source of capital. We've actually had a lot of startups successfully raise hundreds of thousands of dollars in some cases there. This is also when you should be actually looking to your customers to maybe even invest in your business, invest directly or indirectly in your business. We have a quote on the stairs from Esther Dyson that I love. It says, "The best investor in your business is your customer." Okay, because they're validating that you're building something that is important to them. And that doesn't have to be an investment in the form of equity. It could just be a pre-order or making prepaying for something. And it's really an informal way of essentially what Kickstarter and those kind of services do for you. Okay, also there's something called the SBIR program. Particularly if you're thinking about commercializing research or developing something that's based on the work that you do here in the university, you might want to think about an SBIR grant. The SBIR grant program is administered by the federal government. All the major research funding agencies participate in this. It includes the National Science Foundation, the National Institute of Health, Department of Defense, NASA, Department of Energy, and a few others. And collectively, they give away every year billions of dollars. I think the total amounts to about $3 billion per year in the form of grants, meaning that there's no strings attached other than you have to achieve the objectives of the grant, but you don't have to give them an ownership stake in the business and you don't have to pay them back. Okay, that makes them the single largest startup investor in the country. Okay, that the federal government's investing $3 billion a year. We're leading a workshop on this in a couple of weeks. On 2 weeks from today, on the 7th of November to be precise. If you're interested in learning more, that's another startup school session that you can sign up for. Accelerators, things like Techstars and Y Combinator and Entrepreneurs Roundtable and AngelPad and others are yet another source of early stage capital to help get your business off the ground. Actually, tomorrow, our good friend Alex Iskold, the managing director of Techstars, is actually going to be here to talk about accelerators and the role that they play in startup growth and development. And it's going to be a very informal Q&A format. And you can talk to Alex about that. And then this is also when friends and family often invest in startups. And that friends and family is not a euphemism for something. It actually literally means your friends and your family. And these are the people that are going to invest in your business because they know you and love you and believe in you, okay? Even if they're not professional investors. Okay, where we typically see the angels and the seed funds, and we'll talk more about what that means, but these are the very early stage professional investors, is in this customer creation phase, when you've validated demand for your product and now you're trying to scale that demand and prove that you can acquire customers economically. Okay, so if you can't acquire, you can have the best product in the world. If it costs you more to acquire them than the revenue you're going to get from the product, then you really don't have much of a business. Okay, so, and that's often where angels and seed funds like to invest, and then these venture capital funds tend to invest really when these businesses are scaling and really growing. And they want to help you get from those 10,000 or 100,000 or a million users to 10 times, 100 times that. Okay? And these are not for discrete phases. It's really more of a continuum. You will see different investors cross over and come in at different stages. But directionally, this is a way that you should be thinking about it. And of course, beyond that, there's public offerings and private equity and vendor finance and a variety of other sources of capital out there when you have profitability and cash flow and other things and you're looking to scale your business even further. So again, when we talk about venture capital, this is really the category that we're talking about on the right side here, when you're really in that customer creation and company building. Now, in that pre-seed phase, when it's typically the founders and the friends and family investing, okay, we're usually talking in the relatively small amounts of money, in the thousands to occasionally, I've seen that get up into the hundreds of thousands. And these are people putting their own money in. And they're typically investing in one round of a company. And as we'll talk about, many companies will raise multiple rounds of financing. Maybe they'll raise money today and they'll raise more money a year and a half from now and more money 3 years from now after that. These friends and family will typically invest once in the very early life cycle of the company. Angel investors and these smaller seed funds or micro funds or super angels, they go by lots of different names, will invest slightly larger sums of money, but they're also typically investing their own capital. Okay, there's money that angels essentially are frequently wealthy individuals or successful entrepreneurs or sometimes even VCs doing it on the side who are going to invest in the very early stages of startup growth. Okay, and they're investing their own checks, from their own checkbook. Okay, they can often move very, very quickly. The terms are usually a little bit more friendly or a little easier, and they also typically will invest in one round of a company's life cycle. Okay? The venture funds, okay, this is the Union Square Ventures, the Sequoia Capitals, these kind of brand name venture funds, Andreessen Horowitz, Kleiner Perkins of the world, are over in this bucket. And they are managing pools of money for other people. They are essentially money managers in the same sense that a mutual fund. Has anyone here invested in mutual funds, either for their retirement or personal accounts? No? Or give money to a stockbroker or anything like that? Okay, well, I hope you all have the privilege of doing that at some point in time. But these people aggregate money from other investors and then invest it on their behalf. Okay, and if you invested in a mutual fund, say from Fidelity or T. Rowe Price or Charles Schwab or someone like that, you invest into a pool of capital with other investors, and then there's a fund manager who invests that money into stocks and bonds and other things like that for you. Okay, same basic principle here, the difference being that they're investing not in public stocks and bonds, but rather in small private technology companies. Okay, they typically are investing larger sums of money, okay, typically starting at the $2 million and up, though you do see them go down, but sometimes they will invest in the tens and hundreds of millions of dollars as well. And they're getting their money from other people, and we'll talk more about that in a second. And they also will invest over the life cycle of the company in multiple rounds. So again, when we talk about venture capital as a class, we're really usually talking about these angel funds, seed funds, and the larger venture capital funds. So how does venture capital work? What is their business model and how do they make money? So as a first thing I mentioned, VCs manage OPM, okay, which stands for other people's money. So if at the beginning of a fund life cycle, they will raise a fund and get commitments from investors to a pool of capital. Okay, let's say it was a $100 million fund, and they will go out and raise that from the kind of organizations you see here: pension funds, foundations, endowments meaning like universities, though NYU is not a big player in this category. Schools like Harvard, Yale, Princeton, Duke, and Stanford actually commit lots of money into this, as do the state pension funds. Texas and California in particular are very active in this space. Foundations, like some of the same foundations you hear, like if you listen to National Public Radio. Financial institutions, Wall Street firms, funds, insurance companies, and also family offices. Anyone here know what a family office is? Well, I hope you all have one day. A family office is when you are wealthy enough that actually you can afford to employ a full-time staff to invest your money on your behalf. So if you have in the hundreds of millions of dollars or billions of dollars in wealth that you're looking to invest and manage, then you might actually have a family office. So, the Gates and Walton families certainly have family offices, and those types of folks also will invest. Okay, so the fund manager, okay, that would be like the Union Square or Sequoia, will raise that money and get that money committed over a 10-year life, typically, okay? And that means that over 10 years, they will invest that money and try to generate returns for their investors. Okay, so typically they will invest that money in their first fund over the first 3 or 4 years of that company. They'll do initial rounds of investment in those companies during that period. And then in the subsequent years, they'll do follow-on investments. They'll stop investing in new companies. So maybe they'll invest in your company, and your company, and your company in years 1 through 3 or 4. And then in the subsequent years, they're going to make second bets, third bets, fourth bets in your respective companies. Okay? Now, that's important to understand, and it's because you don't want to be getting money from an venture investor if there is 2 years left on their fund. Okay, because that means they're expecting to get their money back within 2 years. Now, in practice, there are often extensions given for these funds, and it's not like everything wraps up with a bow perfectly on the 365th day of the 10th year, but directionally, they do need to begin to return the money. So the way that they return that money, we'll talk more about this in greater depth, is by selling those companies, either to other large companies or onto the public markets through an initial public offering. And if the fund returns are greater than the fund investments, then in simple terms, they've made a profit, okay, for their investors. So if this triangle is bigger than this triangle, then things are good, okay? Now, it's not linear like this, and it's not all so nice and smooth, but I just kind of illustrated that way to simplify the story for you. Now, the way that the investors make their money is this third point here, the 2 and 20. The 2 refers to an annual management fee that they draw down from their investors. So on a $100 million fund, they will typically draw a 2% management fee, and that'll be $2 million per year over the life of the fund. Okay, now that sounds like a lot of money, but if you're running a 4 or 6 person firm with a support staff and you have to pay office rent and travel and marketing and utilities and broadband and all that stuff, okay, the money has to cover all of that. The management fee is intended to pay for the operating expenses of the venture capital fund in its entirety. And if they need more money, tough. That's the extent of their budget for the year, and they have to work within that. Okay? Now, venture capitalists can draw a nice salary from that, okay, but they don't get rich on that, because what they're really playing for is the 20. Okay, and that refers to the carried interest, which is a fancy way of saying profit sharing. Okay, so if the fund returned, let's say, $200 million, okay, and it was originally a $100 million fund, that would mean that there was $100 million of profit, and they would get to keep 20% of that. Now you're talking real money. Okay, and that's what these investors are playing for. Okay, so you can think of it as the management fee keeps the lights on, but the carried interest or the profit sharing is really where they make their money. And very successful venture capitalists can do incredibly well in doing this. Now, in addition to what we talked about here, typically what you'll see is successful funds will actually be managing multiple funds over time. They will not cross-invest between these funds, but they will begin to raise their second fund, towards the end of the new investment period of their first fund. And then they'll start to raise the third fund towards the end of the new investment period in this third fund. Okay? But what they don't typically do is cross-invest across these funds. So it's a reasonable question for you to ask is, what fund are you investing out of? And if you really want to sound like you're in the know, say, what vintage fund is this? And that's the year that that fund was started. So a fund that was started today would be a vintage 2017 fund. You got to remember that venture capital started really in California, and so it was the whole wine thing. Anyway, okay, that's that. Now, I kind of glossed over this notion of how they get the fund return, so let's talk about that a little bit more. So the way that they get to share in that carried interest or that profit sharing is when those companies are sold, okay, or when they are exited or become liquid. This is some of the vernacular that investors use. And the way they do that is really simply by saying that they buy low and sell high, meaning that they buy stock in companies in the early days when their value is relatively low, and then are able to sell their shares in those companies later on when the company's worth a lot more. So the way that works in practice might go something like this. So this is for a company that was started back in 2004. And you can see here that they raised their Series A round, or their first round of capital, for what we call $1 a share here. Okay? It's not so much important how much they raised or anything, but just keep in mind what the price per share is. Right? So they bought, they sold shares at $1 a share in that first round. They then raised the Series B round sometime towards the end of 2005 at $1.80 a share. And then you can see they raised Series C rounds at $2.25 a share later on, a Series D round, their fourth round, at $3.60 a share. And then they ultimately, in 2011, 7 years later, had an M&A, or a merger and acquisition, meaning they were acquired by another company, okay, at $9 a share. So if I was an angel investor and only invested here at $1 a share, I got a 9x return on my investment. That's pretty good. I'm happy about that. Though it was over 7 years, that's a long time to have that money sitting on the sidelines. If I invested over time and participated in all these rounds, maybe I would have a blended share price of, call it $2.50 or $3 or something like that, and that would be a smaller multiple of the return, but I probably got to put more money to work. Okay, and maybe this last round I got almost a 3x return on my investment in less than a year. So without getting into high finance here, this is a nice happy ending of a company that raised money early on at a low price and ultimately sold it at a higher price. Okay, this makes sense so far? Okay. Now, the way that most companies end up generating liquidity for their investors, okay, is through an acquisition by another company. And that could be another public company, or that could be another private company. Okay, what might be one advantage of being acquired by a public company over a private company? Any ideas? No? Okay, well, I'll give you the answer anyway. If you were acquired by a public company, okay, a private company might give you cash, but they might also give you stock. Okay, if IBM or Microsoft or Pfizer acquired your company today, even if they gave you stock, barring any lockup restrictions, you could call your broker tomorrow and say, sell that on the New York Stock Exchange or NASDAQ and get cash the next day. Okay, so you're able to get that liquidity and return it to your investors immediately. Okay, That's not to say that getting stock in a company, in a private company, is a bad thing. In fact, Facebook acquired a ton of companies in the years leading up to their initial public offering. And they may have acquired a company for $100 million, given them Facebook stock. When Facebook went public a few years later, that stock may have been worth $200, $300 million. So that would have been a nice bump. It doesn't always go that way. It can go in either direction. And I'm not telling you that that's a bad thing. It actually can be a great thing, but there could be downside as well. So when you're being acquired by another company, you're essentially latching your car onto someone else's train, is a way to think about it. But the outcomes can go both ways. The gold standard and what everyone's ultimately shooting for is an initial public offering or IPO, and this is when your stock is listed on the New York Stock Exchange or the NASDAQ or an equivalent kind of exchange. And the reason why that's the gold standard is generally to get a public listing these days, you have to achieve incredibly significant scale. And these are the companies like Snap and Twitter and Facebook that get big enough that they can go public these days. They have enough revenue, enough profitability, and enough scale to do that. I believe that the number is less than 1% of companies that exit or actually ever go public. So while we aim for the fences, the reality is the overwhelming majority of companies are either merged by a into another public company or into another private company. All right? What investors are not looking for is for you to sell off the assets of the company or to give them cash from dividends. Okay, they're looking for that big return at the end of the day. And we'll talk more about that as well. Okay, and that's really important to understand because VCs do not make money on every deal. Okay, in fact, it's a somewhat depressing statistic, but 75% of startups fail to return their money to their investors. Not because of lack of effort, but just in practice, the businesses don't succeed at the end of the day. So investors go into this knowing this. Okay, now obviously we think every investment that we're going to make is going to be successful. We think everyone is going to be the next Facebook. Okay, but in reality, that's not true. Okay, so knowing that, you have to manage the risk of your portfolio accordingly and invest knowing that a good portion of your portfolio company is going to fail and not return any capital, and that you'll have one or two companies in your portfolio which will actually generate the majority of the returns for you and to your investors. Okay? So that's really important to understand. The challenge is, as an investor, you don't know which ones are going to succeed and which ones are going to fail until typically it's really too late. Until you've put so much money into them that there's no opportunity to get it back because the money's been spent. Okay, so most investors, a failure is simply that it's written off. They don't get anything back from the company unless there are some assets to sell, which is usually the last thing you do before you shut it down. But they're really playing for a 10x, 20x, 100x return on investment in their company. And now that might sound really greedy, but in order to generate the returns that they need for their investors to satisfy their return expectations and to give themselves some skin in the game, this is the way it needs to work. And if you can do the math yourself, if you think about that $75 million of a $100 million fund is going to go down the drain, okay, what multiple do you need to get on that $25 million in order to generate enough return that your investors can get something better than they could have gotten by putting it into the stock market themselves? Okay, so that's where you start to get into these extraordinary returns that are required. Right? Does this all make sense so far? Okay, good. I want to shift gears now and talk a little bit about VC math and understand what raising venture capital means to you and your business. Okay, because I mentioned at the beginning that if you're going to raise venture capital, you need to give up something. Okay, what you're going to end up giving up in exchange for that money, which if you need it to grow your business, then you need it, is you're going to end up giving up a piece of your company. And that's not a bad thing, but it's just a reality that I want you to understand as you go into it. So we're going to imagine a fictitious company. I don't know if you guys know each other, but we're going to pretend your founder is working on a startup together, okay? And for the purposes of this conversation, we're going to assume that you're just treating each other as one unit. Okay, if you're going to keep 60% and only give her 40%, or vice versa, that's fine. But we're going to treat you as 100% for now. Okay, and so we're going to imagine that you did some ideation and you applied to Summer Launchpad, okay, which is our startup accelerator. I'll tell you more about that at the end of the talk. And you got accepted. Okay, so we're going to teach you how to define your risky hypotheses and how to actually do some customer discovery and customer validation and ultimately help you get to problem solution fit. Okay, so you have a matching of the need in the marketplace and the solution that you're going to build to create it. Okay, so you begin designing your minimally viable product. You start testing that. You like the feedback you're getting from the marketplace, so you retain McCarter & English, an excellent law firm that we work with to help you form your SLE, or your separate legal entity. Okay? You then agree to formally put in place whatever agreement you made about how the two of you are going to split up your equity. So now you own 60, she owns 40, or vice versa. And you open an account at Silicon Valley Bank to deposit all the money that you plan to make in the future. Okay? You're now in search of product market fit. You continue testing your minimally viable products, doing more customer discovery and customer validation. You begin to secure your early adopter customers. You get to product market fit. You get a nice write-up in TechCrunch. And now you realize that you can't just do it on fumes and the $10,000 that you got when you joined Summer Launchpad. So you decide it's now time to raise your first seed round. Okay? And so you hit the streets, and 3 months and 30 pitches later, and by the way, I keep meaning to update this, but 3 months would be very fast, okay, if you raised your seed round in 3 months. But let's say you guys are so good, and because you did so well in Summer Launchpad, it went smooth sailing, and you got Graycroft, which is a great early stage seed fund to invest in your startup. And they said, we're willing to invest $500,000 into your company, but you need $1 million. So you then get the NYU Innovation Venture Fund and 3 other angels to invest alongside them for a total of $1 million. Okay, everyone with me so far? Good. So now, Graycroft says, okay, great, you raised the $1 million. We're willing to invest that at a $3 million pre-money valuation. What does that mean? Okay, the pre-money valuation is actually very literally what it sounds like. It means, what is your business worth before the money comes in? Okay, so they're saying that your business is worth $3 million, okay, and we're going to collectively as a group invest $1 million so that your post-money valuation is $4 million. That's meaning, what is your business worth after the money comes in? If it was worth 3 before, you add $1 million, it's now worth $4 million. That's the very complicated math. Okay, so why is that important?
It tells you how much of the company you no longer own.
That's a glass is half empty way of saying it, but yes, it tells you how much, it tells the investor how much of the company they're buying. Okay, so in this case, they are buying 25% of your business, okay? Because your company is worth 3, they bought 1 million, so it's just 1 over the post-money valuation. Okay, that's the very complicated math we were talking about. Okay, so now collectively you guys own 75% of your business. You deposit your money with Silicon Valley Bank. You pay McCarter & English, whatever it costs to document that transaction, and you decide to get back to work. You then very quickly realize that you can't do this alone, and you actually need to hire some people, and because you want to save as much of your cash as you can, you want to incentivize them to join your company and give them some stock options. Okay? Now, stock options very simply are a way to enable your employees to participate in the value creation of your business, so that when your business is sold, they get some payoff for that. Okay? And so in this example, you decide that you want to set aside 10% of the company, okay, 10% of the stock of the company for those employees, okay? So You authorize those shares, and that means the pie still is only 100%, so that means everyone gets diluted a little bit. Okay? So you hire those first employees, you begin to identify that repeatable and scalable business model, you get a nice write-up in the New York Times, you then realize it's about 18 months later and you're starting to run out of money, and so you decide it's time to hit the streets again. Okay? This time around, you begin your pitch. This time it took 6 months and 40 pitches, but Flybridge Capital, a great VC fund, decides that they're going to invest $2.5 million in you at a $7.5 million pre-money valuation. Okay? So that works the same way as it does before. That determines how much they're going to buy. The caveat is this time they're saying, we're glad you have an option pool, but we actually think you're going to need more options. Okay? Maybe you've decided you need to bring in a CFO or maybe even a new CEO or hire a larger engineering team, and that 10% is not going to be enough to go around. And for argument's sake, let's say you agree with them. Okay? The asterisk is to indicate that the investor is telling you that they want that to come out of the pre so that after their money comes in, there's 15% left over. Otherwise, that 15% would shrink down after their money came in. And they don't want to have to pay for that. They want the existing investors and the founders to pay for that. Okay? And so the way you do that is for a very fleeting moment, you over-allocate the number of options that you would need so that when Flybridge's money comes in, that now shrinks down to 15%. Everyone with me on that? Okay? So now Flybridge comes in. They bought 25% of the company, right? Post money of $10 million. They invested $2.5 million. And the remaining $7.5 million of the pre is spread out between the founders, the seed investors, and the option pool. Okay, you're not getting a payout of that, but that's the value of your stake in the business. Okay, so now the founders own 45%, the seed investors 15%, the options, an option pool worth 15%, and Flybridge owns 25% of the company. Okay, so congratulations, that's a 50% step up in value from the seed round. Okay, right? The company was worth, your stake was worth $3 million before the seed round. Now it's worth $4.5 million. Step up meaning it's just industry speak for increase in value. You have $2.5 million in the bank. Right? John Elton from Graycroft and David Aronoff, two top VCs in New York City, are on your board of directors and helping you steer the company. You're growing a team. You're scaling your business. Life is good. Okay, this is another happy outcome. Now, some of you might be looking at that 45% and saying, yeah, but I only own 45% of my company. Well, that's why I said at the beginning, if you are going to take money, you're going to have to give something up. And this is actually decent terms that you're getting on this business at this point in time. If you don't need to raise venture capital and you don't want to give up something in your business, then there's no law that says you have to raise venture capital or raise investment capital at all. If you can fund your business on your own, more power to you. Okay, but if you do want to build something that is going to scale very large and you need to invest up front to hire people or equipment or buy inventory or whatever the case may be, then maybe venture capital is an option for you. Okay? What I want you to take away from this is that if you raise money, you will be diluted if you're going to raise investment capital. Okay, you can get grants and all that, but those usually don't scale up to the same level that venture capital does. Now, the scenario where I showed you after the seed round here, that the options would be issued after the investors come in, is actually fictitious. It never works that way. I just showed it that way just to contrast the scenario of where the dilution of those options hits. Okay, in reality, it's going to be more like it was after your Series A round, okay, where the investors are going to say, if you identify that, yes, you're going to need to hire people and you're going to want to incentivize people, the expectation is that that will come out of the or from the founders or the prior investors, okay? That's the way it's worked in 99 out of 100 deals that I've been involved in. The best way to have that not happen is to have a rocket ship that they are dying to invest in, and then you can dictate the terms that it won't be that way. But in practice, that's generally the way it works. Okay? Now, I showed you a happy outcome here. So the timing of your raise will be key. As we'll come and talk to, we'll talk to in a few minutes, you raise money when you can raise it, not just when you need it. Okay? You guys did a great job. You built the company. You got traction that convinced the investors to get behind you at the right time, and you were able to raise money at an increasing valuation. Okay? Just if things were not going well after the seed round, and you still needed more money, but you hadn't made material progress, you might only not have been able to raise money at such good terms. You may not have been able to raise money at all. Okay? So you need to keep that in mind. So you need to think and plan for how much money you're going to need, how long it's going to last, what you're going to accomplish with it, so that and take into account what's going to go wrong to the best of your ability to anticipate what's it going to take to get to that next round. What are the valuation and milestone inflection points that are going to attract the next investor to invest? Now, easy for an investor to say this, but your valuation nor your ownership position is everything. Okay, or as the expression goes, I'd rather have a small piece of a very large pie than 100% of a tiny pie. Okay, and that's true here. Your goal should be to maximize the enterprise value of your business downstream, not just to maximize your ownership today. Now, I'm not telling you just give away the farm, but there's a balance in that tension there, okay? But again, if your goal is to maintain 100% ownership or control of your company, then you have to keep in mind venture capital is probably not right for you, okay? Also, this is a very complex process. Okay, these are some of the terms that you will come to learn and hear if you do raise a venture round. Now, you don't have to become a master in all of these. Okay, that's why we have lawyers. But you want people in your corner who've been through this game before, who know what every one of these phrases and terms means, understands their significance and impact to you and your business and your personal situation. Okay, so that certainly means a good lawyer, but it also means it could be an entrepreneur or a coach or someone who is on your side and can guide you through this process and tell you what to do, how the game works, and so that you know what you're getting into. Okay, but you also need a really good lawyer. Okay, and law is actually like medicine in the sense that they specialize. Okay, and while any doctor can do a certain amount of medical procedures or practices, they can't do them all. Okay, and just like if your heart was hurting you, you wouldn't go to an orthopedist. If you had a rash, you wouldn't go to a neurologist. Okay, you would go to a cardiologist and a dermatologist accordingly. Same thing for your legal needs, okay? And while they don't always have the same societies and all that, they do in the larger firms all specialize, and they list that on their website. So just like if you were having surgery, you want someone who's done that surgery 100 times before, maybe 1,000 times before, okay? Same thing with your lawyer. You want a lawyer who's done hundreds, if not thousands, of venture financings. So they know the game that you admittedly don't as a first-time entrepreneur. Okay, so you want one who is expert in doing venture financings. Okay, the good news is in New York City there are literally dozens of attorneys, dozens of firms who have attorneys who specialize in venture fundings and do this every day. Okay? You don't have to use someone in New York. Okay? 20 years ago, you had to go to Boston or Silicon Valley to get a good startup lawyer. Now there are tons here, and one of the things that we can do is recommend them to you if and when you're ready for that. So we'll talk more about lawyers in a bit. Okay, so when should you be looking for venture capital? I won't rehash this, but right, we talked about this chart a little earlier, right? Venture capitalists tend to look to fund these larger scale businesses here, angel or businesses that are scaling, angels and seed funds at this slightly earlier stage. I imagine most of you are probably somewhere in one of these first two stages. Okay, so again, as we said, just because you have an idea doesn't mean you're ready for venture capital. Okay, and we're happy to sit down with you at any point in time and help assess where you are actually in your journey and what are the appropriate funding mechanisms for you at any point in time. Now, another thing to think about, aside from the obvious dilution of raising funds, is it is a time-consuming, distracting process. Distracting because you didn't start the startup to raise venture capital. You started your business to build a business. Okay, and if there's 2 or 3 of you working on this startup, and one of you is spending the majority of your time, and that's what it will be, the majority of your time raising capital for a period of months, that's like losing a third leg on your stool. Okay, and it can be really hard to keep the business going during those phases. So it's important to make sure you're focusing that effort when it's going to yield results. Okay, and you can talk to founders in here every day about this who didn't heed that advice and went out and tried to raise venture capital prematurely and essentially wasted 3 months out of their startup life at a time when they really couldn't afford to do that. Because as an early stage entrepreneur, your most precious resource is time, because you don't have money. And time is the thing that you need to build and grow your business. So use that judiciously. As I mentioned, if you can avoid raising money early, you will minimize your dilution. Okay, dilution is inevitable, but it can be minimized by selling shares in your company when your valuation is higher. Also, it's really hard to stop spending money once you start doing it. Okay, once you hire an employee, they expect to be paid every week or every month. And the fact that you run out of money doesn't mean like, oh, they're just going to be like, oh, okay, no big deal. You know, just pay me when you can. It doesn't really work like that. Okay? And then also things like landlords expect to be paid every month. Utilities expect to be paid every month. It's really hard to turn off those expenses really, really quickly. So if you can avoid starting those, do. You will also spend it on the wrong things. You know, kind of like, you remember when you got your first paycheck and you felt rich? And you went out and you bought a fancy bottle of liquor, or you took your boyfriend or girlfriend to a nice restaurant, or you did something and then next thing you know, that money's all gone. Well, it's the same humans running these startups, and the same tendencies sometimes will prevail. You'll spend it on a logo or getting a big sign for your office, and while those things might be nice and important at some point, they're probably not going to define the success of your company in the very early days when you have very little capital. The other thing to remember is if you raise that first round, okay, more so than any other round, it's being raised on the promise. Okay, you will likely need to have some traction and validation that there's a business worth pursuing. But the second time around, God bless you, the second time around, your investors are going to say, were you a good steward of that first round? Did you do something with that money that created more value? Did someone invest $500,000 into you and you turned that into $3 million in value? Or are you only, a little bit ahead of where you are now, just a lot of time has lapsed? And that's the best proxy that an investor has of whether you're a good investment at that early stage. Did you actually do something really meaningful with the prior investor's money? Okay? So as I like to say, the first round may be raised on the promise, but the second round is going to be raised on the progress. All right? And if you're wrong and don't hit those milestones, there's a good chance you're dead, meaning that your business is not going to be able to raise money. Most investors don't want to bother investing in a company at a lower valuation than the prior round. It's just not worth the hassle and the pain and the agony for something that's already seemingly going sideways. There are exceptions to that, but the vast majority of the time that's true. And remember, there's many other non-dilutive sources of money available in the early days, some of which I talked about before, and we'll talk more about them again at the end. All right? Is this making sense so far? Good. Some tips on getting funded. So first, let's talk about what it is that investors look for. Okay? A myth is that VCs invest in technology. Okay, VCs do not invest in technology. Okay, they invest in businesses. They may be technology-enabled businesses, but businesses have customers. They have markets. They have value propositions. They have revenue models. They may have revenue streams. They have income statements and P&Ls and maybe cash flow. Okay, they have employees, not just a patent or even an invention or a product. Okay, they're looking for some manifestation that it's a business. So they don't invest in ideas. They don't invest in technologies. Your technology is simply one element that is critical to the building of your business. It's important to think about that. So to answer the other question about what it is that VCs look for, I like to talk about this in the framework of the 5 Ps. Okay, first is that you have customer validation of a meaningful pain in the marketplace that is not currently being addressed by someone else. Okay, or that it is being that you've delivered something, a product or service that is differentiated from other solutions in the market, and you have the evidence to prove that. Okay, first, solving a meaningful problem. Second, a differentiated solution. Also, that the business has potential. Okay, potential meaning that there is a large and ideally growing market, and that you can make money in that market. Okay? Fourth is that the team has demonstrated that they can begin to move the ball downfield. Okay, that you've gone from an idea to a validated solution to building an actual product to actually getting it in someone's hands. You're first-time entrepreneurs in most cases, that's fine. Okay, they're not expecting you're going to have the pedigree of a Mark Zuckerberg or Elon Musk, but that you've demonstrated that either with your hustle or whatever resources you've invested in the business so far, that you've been able to make some meaningful progress up until that point. Okay? And then finally, implicit within all that, and at the core of that is the people. Okay? And that the team is committed and focused and passionate and persistent about the problem that they're trying to solve. Okay? And again, they're going to look for the hallmarks of that in the progress that the team has made already. Okay? Now, my friend Arthur likes to talk about this VC deal flow funnel, and I think it's a useful way to think about this. So an average venture capital fund may see 1,000 to 2,000 investment opportunities a year. Okay, and that fund may have 3 to 6 people in it that needs to sort through all that. You don't have to even do the math to realize there's not enough hours in the day to take pitches from all of them, okay, and do diligence on all of them, meaning spend real meaningful time to assess the investment opportunity. So your goal in your first contact with that investor is not to get them to invest. Okay, it's to get another meeting. Okay, because on average, you will have 6 or more meetings before you actually get to a decision about whether or not they are willing to invest in your company. So that executive summary or that pitch deck or that first encounter with the investor is just to whet their appetite and get them interested. Okay, it's kind of like if you ever bought a house or a car, it doesn't just happen on the first encounter. Okay, that's even more so true here. So the goal of getting onto their inbox, as Arthur likes to talk about, is to get on their desk, which is a euphemism for saying being front of mind, not being relegated to the credenza, which is behind them, out of sight, out of mind. If you're on my credenza, I forgot about you already. Okay? And the goal of that is then to get to that meeting. As I said, you go through several cycles of meetings, and ultimately at some point they give you an indication that they want to invest. They begin to do maybe some meaningful diligence, meaning they'll maybe start to look at, they want to meet more members of the team. They might want to look at your intellectual property if you have any. They may want asking you for more information about your metrics or results to date or your financial information, your contracts, whatever it might be, until ultimately that leads to an investment. Okay, so again, just the thing to remember about all this is your initial goal is to get a meeting. And your goal of that first meeting is to get a second meeting. Okay, so don't try to tell them everything you know in the planet in that initial meeting in order to get them to invest, because it's not going to happen. Okay? Another myth is that you raise money when you need it. Okay, this is, I think, actually the most damaging myth of all the ones I raised here. Because the fact that you need money is not of interest to an investor. The fact that they can make money by investing in you is what is of interest. Right? So another way to say that is that you raise money when you can raise it. Okay? When you have some demonstrated progress or validation that there is a business worthy of investment. Okay? That it can achieve certain scale, and that some of the risks have been mitigated already. Now that's easier said than done, but that's also how we can help you in sizing up where you are in that point. Because running out of money is not a milestone. Okay, in fact, it's to your disadvantage to be out of money. Okay, the companies that get the best terms and raise the most money are the ones that aren't trying to raise money. Okay, the ones that have a business that is taking off and that the investors want to get a piece of that. Okay, and sometimes they will take that money because it can help them scale faster or achieve something better than they might be able to otherwise. Okay, another myth is that VCs are hard to meet. VCs are actually very easy to meet, okay, because they are out there looking for you. Okay, they're the buyers. They're out there hunting for the best startups to invest in. So they put themselves out there. Okay, if my bag of money here is euphemistically the people that you're trying to meet, right? Leverage your network. Do you have coaches or mentors that have connections there? Maybe you know another respected VC or angel who might not be a fit for you, but who could connect you with other folks. Could be another present or former portfolio company executive. It could be a well-respected entrepreneur or investor. It could be a service provider. All the more reason to use a lawyer or an accountant or a bank that specializes in working with startups. They have networks there. It could be a social connection. I have friends who are terrible entrepreneurs, but who are always asking me to introduce them to VCs when they're working on a new startup idea. And it could be us as well. Okay, and by that I don't just mean by asking us, but by, tomorrow Alex Iskol, the managing director of Techstars, is going to be here. Okay, we also host office hours with folks like Alex and other investors. Last week, John Elton from Greycroft was here. We had folks from Two Sigma here 3 weeks before that. There are always folks coming in and out of our programs because they want to meet you guys. That's why they speak at panels. That's why they tweet. That's why they blog. Okay, so they want to be out there. They want to be visible. Okay? Now, another myth, though, is that you don't approach VCs until you're ready to raise money. Okay? That is a myth. And the way I like to address this one is by talking about a blog post that Mark Schuster, a VC with Upfront Ventures in LA, talked about in a blog post several years ago called Lines Not Dots. And in it, Mark talked about when he first meets an entrepreneur that he doesn't know, he doesn't really know them. And he doesn't really have a sense of how good they are and are they actually making progress? Are they moving the ball downfield? And so in it, he kind of talks about this chart that he creates where there's some arbitrary measure of entrepreneurial performance on the y-axis, and on the x-axis is time. So, but on that first meeting, you're just a data point, okay? What he's looking for is a trend line, okay? So that over time, you know, the first meeting, you introduce yourself, I'm Frank, and I'm working on a startup, we're doing X, Y, and Z, and over the next 3 months, we're going to achieve this, that, and the other thing. Okay, he meets you again 3 months later. Oh, you did all that and you did more. Okay, then you meet again and again and again, and you start to see, and he can plot you on that chart of that entrepreneurial performance metric on the y-axis. Now, in reality, Mark nor anybody else plots entrepreneurs. But when you meet someone, you know that you get a sense over time, do they do what they say? Do they exceed expectations, or do they overpromise and underdeliver? Are they a hustler or are they a talker? Okay, and that's really, I think, the point. So investors rarely, if ever, make an investment based on an initial meeting. Okay, that's another reason why it takes several meetings, because some time lapses in that. And you realize during that pitching process and that diligence process, is the team making progress? Okay, did they acquire more customers? Did they add those features? Did they hire those people? Okay, if everything stays the same during that fundraising process, that's not a good thing. And the fact that you're busy raising money is not an excuse for it, because good entrepreneurs figure out how to do both. Okay, so another way of saying that is the myth that VCs invest in teams with strong data. Actually, I like to say it is VCs like to invest in the trend. What curves are those that you have that are going up and to the right, where you're acquiring more customers, you're driving your cost of customer acquisition down, your monthly retention curve is going up. Okay? You know, when I meet an entrepreneur and they tell me how many customers they have or how many downloads they have, I say, that's great, but what did you have last month? What did you have the month before that? And it might be, you know, you might have 100,000 users right now on your website. But if you had 100,000 last month and 99,000 the month before that, that's not so great. If you tell me that you had, well, last month we had 10,000, the month before that we had 1,000, I say, holy shit, tell me more. Pardon my language. But that's what investors are looking for, okay? And the truth is that when you're not leading with that positive trend, they assume either you're naive and don't understand the process here, or that you actually don't have the numbers, and they don't fall for it. Okay, so if you don't have the numbers and you're not, again, then you're not ready to raise money. Okay. Some final thoughts on fundraising. One is that you should invest time getting to know investors just like they're going to get to know you. And I'm not telling you this because there's bad people out there. Okay, I'm sure there are, but that's not the point. The point is that you are going to get married to an investor. Okay, and actually, unlike marriage, it's actually really hard to divorce your investor. In fact, it's arguably harder to get rid of an investor than it is to get rid of a spouse in this country. Okay? So you want someone who you are going to be with through thick and thin over the life cycle of your company, which might be a 7 to 10 year period. Okay? And you can do that through talking to folks who've worked with them before. right? Talk to entrepreneurs they've backed. Talk to other investors that have co-invested with them. Talk to lawyers who've worked with them, okay? Be prepared for this fundraising process, but don't try to get them to invest in that first one. You cannot tell them everything they need to know in that first meeting. Okay, so go, if you have a half an hour meeting or an hour meeting with them, plan on slides for like 1/3 of that if you were uninterrupted, so that there can be a meaningful dialogue about what it is that you're presenting. Doesn't mean you can't have backup slides and be prepared for all that, but don't go in there with, even if you have an hour meeting, with a 40-page slide deck or even a 20-page slide deck. Okay, less is more. Okay? Also, you don't need a prospectus or a business plan. You definitely don't need a prospectus. Beware of anyone who tells you that you do. If you don't know what a prospectus is, that's fine. You also don't need a business plan. That doesn't mean that you shouldn't be planning. It just means that you don't need a 20 or 40-page written Word document, because no one at these venture firms are going to read it. And if someone asks you for one, it probably means they're not a terribly sophisticated investor. Now, your deck may encompass all of that, but I'm just talking about the time that you're going to take to write 40 pages worth of prose and make it look beautiful and all that. You get very diminishing returns after your very first draft of it. Okay, and it's not going to be read. I mean, remember the number of deals that these guys get. So they're looking for these warm intros, and that's the best way to get in front of an investor. Okay, and also you want professional investors. By that I mean, just like you want a startup lawyer who's done this hundreds of times, you want an investor who's done this, if not hundreds, dozens of times. Okay? You want someone who's going to offer you market rate terms, who's going to understand the process, who's going to understand governance, who's going to understand deal terms that are market. Okay? I can't emphasize this enough, because there is a lot of money sloshing around the system, particularly in New York, where there's just a lot of money, period. If someone is offering you an investment in your company, make sure they've invested in many other startups before. Don't be their first investment or even their second. Okay? Because if they give you terms that are not market, you might have a problem raising your next round. We can talk more about that offline if you want. And also, never hire an agent or a banker at the early stages of your startup. Okay? And the reason for that is really simple. If you cannot raise money from these people who are out there looking for you, then that says something about you as an entrepreneur. Okay? Because this notion of the pitch process is intentionally or unintentionally a proxy for your ability as an entrepreneur to recruit talent and lead a team, to sell to customers, and to attract the right partners that your business is going to need to succeed. And if you cannot figure out how to get a meeting with these investors who are looking to meet with great entrepreneurs and get them to invest money into your company, then that either says you don't have a great business or you don't have the hustle it takes to be an entrepreneur. Does that make sense? So what you want to do is, if you get that meeting, you want to tell a story and engage your audience to get that next meeting and cover the bases about your business. Don't tell them everything, but don't make it just about your product or tech either. Okay? And remember, it doesn't just stop with your pitch deck. Okay? So that means write a thank you note, do follow-up, and all that. The other point I'll say is the best outcome of a first pitch meeting, the best possible outcome, is that they schedule the second meeting right there on the spot. They open up their calendar or they call in their assistant and they try to figure it out. Okay? If they say, thanks for coming in, we'll get back to you, and you don't hear from them by tomorrow, it's not a good sign. Okay? So most people come out of these meetings thinking they went well, and in practice, most of them don't. Okay? So that means just like, ask for that next meeting, and you'll get more signal on whether or not they actually are interested. Does that make sense? Okay. So to net it all out for you, there's a lot of sources of capital to help get started. VC probably comes a little bit later than some of you were thinking before you walked in here. But there's a lot of other sources that are available to you, particularly inside of a university and in the early stages of growth. Remember that venture capitalists, at least the funds, are actually professional money managers, and they are incentivized and will act accordingly. Okay, remember they have a legal and contractual, or as we call it, fiduciary obligation to maximize their return to their investors. Okay, and if you were investing money in them, you would want them to do that. Okay, so they may talk about being pro-entrepreneur and founder-friendly and all that, and that may be true. But at the end of the day, their job number one is to be nice to you only to the extent that it helps them make money for their investors, because that's why they exist. Does that make sense? Okay. Also, focus on the things that drive the value of your business, not just maximizing your ownership stake in it. Okay, that's taking your eye off the prize. Again, I'd rather have a small piece of a massive pie than 100% of nothing. Okay, remember, investors are looking for businesses, not just technology or ideas. Get to know investors early in the process. Don't wait until you either need money or think you're ready to raise money to get to know them. Okay, there's a cliche that's overused but still directionally correct of saying that when you want advice, ask for money. When you want money, ask for advice. I believe in the latter part of that in particular. Okay? So, meaning that get to know them early on. Okay? When you're 6 months before you want to raise money or think you're ready to raise money, go start talking to them and understand what are they looking for in a business like yours. Get some feedback on this, right? They've probably seen competitors of yours that you don't know exist yet. Okay? What kind of metrics, when you say I'd like to see more traction, what does that mean? What kind of metrics? What kind of growth rate? There's no silver bullet on having X number of customers, okay, that defines traction. It's different for different businesses in different sectors at different stages. But you can get a sense of that through an informed conversation with them. Okay? Just like they may be charting you, you want to chart them in your own mind. Okay? Remember, this is a complicated process, so arm yourself, meaning surround yourself with people who know what they're doing, who've been through this before, and can help guide you and support you in this process. And I'll say it again, you want professional investors. I'll spare you the bold font right now. And then finally, that we're here to help. Okay? We're here to help our students and faculty start startups. We, as I'll talk about more in a moment, we have a fund that makes direct investments in startups founded by NYU students and faculty, but we also help make introductions. We'll help you get ready for your pitch. We do workshops on pitching. We'll guide you through the process. Okay? So some funding resources at NYU. Again, the funding life cycle, we have different things kind of at each stage here. The first that I'll mention is our prototyping fund. If you are building or thinking about building a physical product, something in hardware or a soft good, not software, then this is a grant program where we give up to $500 in initial grants to students to help them build something. So if a few $100s is holding you back from actually buying the components that you need or getting access to that specialized machinery to build a product or service, Sarah, in partnership with our friends Anne-Laure Fayard at the Tandon School of Engineering, we give out, how much is it, $4,000 a semester now, in grants to anywhere from 8 to a dozen teams per semester. This is the 9th cohort that we're running right now. The teams that participate not only get money, but they also get training and support and coaching. And then there's also a showcase at the end where we invite the community to show off the progress that you've made. We've had teams over the years that have participated in this go on to enter and win the Entrepreneurs Challenge, the Innovation Competition, participate in our Summer Launchpad program, go into Techstars, raise venture capital. I think as of this moment, we have 4 or 5 that are actually generating revenue from something that got started. We have one of them over here. We have a prototyping fund grantee. Who's in the prototyping fund right now? No one? Oh, here. I'm sorry. I thought you were pointing over there. Great. Awesome. So that's the prototyping fund. And then if you make sufficient progress in your phase 1 grant, then we actually will offer, or you're eligible, I should say, to apply for a phase 2 grant of up to $2,000 per team, right? All right, so that's the prototyping fund. Another new initiative that actually we just announced yesterday is something we're calling the J-Term Startup Sprint. And this is for NYU students and postdocs. It's a 2-week intensive startup sprint, boot camp program, immersion, however you want to think about it, where we're going to teach you how to go from an idea to startup in 10 days. If you're around during J-Term, the dates specifically are January 9th through the 22nd, I believe. So it's 2 full-time weeks, and you can commit to doing nothing else during that time but working with us and working on your startup. We are offering info sessions about this over the next few days. I'll give you the dates of those at the end. And each team gets a $350 grant for the 2 weeks in the program, and then we will give up to $3,000 in grants to 2 or 3 teams at the end of the program that are the top performers. And again, that's grant money. So that's the J-Term Startup Sprint. Applications will be due for that on November 20th. There's also another program that is run, in this case, outside the university, but specifically for university students who are working on engineering or technology-based products that have a social impact. Okay, social impact, simple way to think about it is if you're working in healthcare, education, environmental sustainability or clean energy or serving underserved communities, then you're a fit for this. If you're working on another app to figure out who you're going to have dinner with tomorrow night, this is not for you. Okay? But it's run by a nonprofit called VentureWell, and they will give initial grants of $5,000 and second phase grants of up to $20,000 to teams that meet that criteria. If you're interested in applying to this, they have 3 flights or 3 cohorts per year. We just passed the deadline in early October for this. The next one is February 7th, 2018. Are we doing another info session for this, Sarah? All right, so we'll do one in the very beginning of January, so you have some time. But if you're interested in this and you think you fit, you should start learning about this now, because I don't want to overstate it, but it's not an application process you can complete in a half an hour. Okay, you need a letter of recommendation from me. You need to identify a faculty member who's going to be the PI or the grant recipient on it, and will dole out the funds to you, and you need support of the Office of Sponsored Programs. All of this is not impossible. It just takes a little bit of time and a little bit of planning and coordination. We've had over 6 teams from NYU get these grants in recent years. A couple have gone on to get phase 2 grants as well. It's a great program. It's next to no strings attached, and it's free money. We also, through the Office of Sustainability, NYU offers something called NYU Green Grants. We have an info session for this later this week.
This Wednesday, we're holding an info session on the Green Grants program, and if you're at all interested, I highly recommend coming. It'll be at 3 p.m., and we'll go through what makes an effective application, and a few other things with the Office of NYU that gives out these grants. These grants are given out on a rolling basis, so if you're interested, I
So as the name would suggest, these are for people doing something to green NYU, the city, or the larger planet. They have funded programs that are very NYU specific, not necessarily a startup, like actually the bike share program at NYU came out of this several years ago. But also what you see here is a team, the founders of EdenWorks, two of whom were NYU students a few years ago, who now have a very successful vertical aquaponic farming business growing in Brooklyn, growing literally and figuratively speaking. Jason Green, the founder on the left, you got a $20,000 grant to help get that started and built the first pilot for their business with that funding. So again, if you're in that sustainable green energy world, you should definitely come to the info session for this. This is great money with very lightweight process and no strings attached. There's also several competitions, startup competitions run within the university. The largest one is the NYU Entrepreneurs Challenge. That's where $300,000 is given out each year. As part of that, it's run by our colleagues at the W.R. Berkeley Innovation Lab at the Stern School, but it's open to the entire university. That competition has already started for this year, so you need to think about next year for that. But there's also the Innovention competition, which is coming up next semester. And there's a few other social impact centric competitions as well, the Changemakers Challenge and the D-Prize competition. More information about all these on our website, but this is a great way to get money as well as training and support for how to take your startup forward. I mentioned this earlier, but we also, in the Entrepreneurial Insitute, run something called the NYU Summer Launchpad. This is a 10-week intensive accelerator run out of this space over the summer. Each team gets a $10,000 grant. They get training. They get mentorship from entrepreneurs from the New York City startup community. They get 24/7 access to the Leslie E Lab for the summer. A lot of food and a lot of learning and a lot of fun. We've been running this for 5 years. We get about 100 applications each year for 10 spots. We prioritize teams that are graduating that year. So if you're a senior or a second-year master's student or a PhD student, you should definitely be thinking about this. But we have taken underclassmen as well. And then finally, we have the NYU Innovation Venture Fund. This is the fund that I mentioned earlier that I manage, that it exists solely to invest in startups founded by NYU students, faculty, and researchers. We invest alongside other angel and early stage seed investors. So if I were to go back to our diagram here, we tend to invest in and around this phase. So we're looking for early evidence of customer traction, validation, and growth. We have, as you can see from some of the logos here, that we've invested in over 17 companies. You can tell by some of the names we're pretty sector diverse. We've invested across healthcare, clean tech, and information technologies, including e-commerce, mobile apps, artificial intelligence, hardware, software, you name it. We're looking for great founders addressing great market opportunities. If and when you're ready, we're always happy to talk with teams about this. And then, so last thing I'll lead you with is, if you're thinking about raising money, okay, if you grokked everything that I've shared with you to date, you need to know the answers to these questions for yourself before you really go out in the marketplace. That's not to say you need to know the answers to all these before you talk to us, but before you really are going out and asking other people for money, you need to know, is this the right time to raise and why, right? How much are you trying to raise? And you'd be surprised how many pitches I see where they don't have no idea. They just know they need money. They don't really know how much they need or why they need it. You should know what you're looking for in an investor, right? Aside from the fact, obviously, that their money is green and that the check will bounce, what other types of value add are you looking from them, if any? Right? Do you want someone who is going to be a consigliere or advisor to you? Are you looking for someone who can open doors? Are you looking for someone who has portfolio companies with synergy? Are you looking for someone that has shared services that you can benefit from? There are investors who have space that you can work out of, or who have a PR person on their staff or a recruiter on their staff that you can use at no charge. Are those things important to you? If so, you may want to prioritize other certain firms and de-emphasize others. What are you going to spend the money on? Okay, you should have a fairly detailed concept about this, about what you're going to spend the money on, how long it's going to last, and what are you going to accomplish with it. Okay? You should also know that what investors are looking for in you. So that goes to talk to them before you're ready actually to raise money. And then be able to answer the question, directly or indirectly, why should they invest in you? Why is this a great business opportunity? And how are they going to make money by investing in you? Okay? So that doesn't mean that you have to have a slide about your exit strategy, but you should have thought about it. Okay? You maybe even have spoken to some of those potential partners or acquirers in your market, so you understand what they're looking for. So you're aiming for that target downstream. But at the same token, you shouldn't be obsessed with your exit strategy, right? Most investors will get worried if you're talking too much about your exit. Okay? So there's a tension there. You need to be thinking about it, but your emphasis and focus should be on building a large business. If you build a successful large business, the acquirers will emerge. And then, will you need to raise more money? Right? Is the investor who invested you going to be diluted? By how much? And when? And then what are those investors looking for? So I know this sounds a little harsh, but if you can't answer all those questions, then you're probably not ready to raise money. That said, we're willing to sit down with you at any point in your journey and help you figure it out. I'd also strongly encourage you, if you haven't already, to sit down with a member of our team, one of our coaches. We call them our Blackstone Launchpad coaches. Due to a generous grant from the Blackstone Charitable Foundation. We will sit down with you no matter where you are. If you want to learn how to spell entrepreneur, or you're ready to raise money, or anywhere in between, we're happy to sit down and help you. Okay, we do this all day, every day, with students and faculty across the university. Going back to fundraising, I'm happy to take any questions that any of you might have.
Hey, can you talk about the SBIR and what happens to the intellectual property associated with that grant, those kinds of grants?
Well, the intellectual property that the team owns, the government doesn't lay any claim on because they gave you a grant. It's non-dilutive. It's a grant, and the grant in this case would go to make a long story short, because it's complicated between the difference between SBIR and STTR, but to the company. And it doesn't really have any bearing on your intellectual property.
Second question, and this might be something for a different time, but can you talk a little bit about valuation? Because it seems that people have a lot of different opinions on valuation, because oftentimes it's made up, oftentimes it's based on some kind of a stream, and I'm just curious how, like, the best way to go about valuation.
So generally speaking, if I understand where you're going with that, the investors typically will be the ones that determine the valuation, okay, because they're the buyers. Okay? Now, that being said, it's really hard to put a value on a business that doesn't have any revenue, okay, where all it is operating losses, okay, if that. You may not even have operating losses yet. Okay, the way that classical financial analysis tells us is we look at revenue, we look at profitability and cash flow streams and comparable company analyses, but all that is out the window for startups. So that was the reason why I told you earlier that the majority of an investor's portfolio company is going to fail. So one of the ways that they try to assess valuation is by backing into what they need to get in order to justify the returns that they need in their portfolio, okay, understanding that the majority of their portfolio is going to end up losing money. And so that's why I raised some of those questions about how much are you going to raise, how much more do you need to raise, when are you going to raise it, what are you going to accomplish with it, so they can start to have a sense of, okay, what's the potential of this business? What's the dilution that they're going to bear? How much capital is this business going to need? And you can start to do some either very sophisticated or primitive analysis to model that. And that will help to give them some boundaries for, okay, this is what this business may be worth down the road. Okay, adjusting for risk. This is the amount of money it needs to raise. This is what my return would be. Therefore, I need evaluation of this today. Is directionally how it works. That said, the best way to maximize your valuation is to A, have a kick-ass business, and B, have multiple people trying to invest in you, right? If there's multiple buyers for a house, what happens? The price goes up. Same thing with your company. Okay, so that's easier said than done, but when you have one buyer and they have the money, then more often than not, they're setting the valuation. It can be a negotiation, but they're not going to put a lot of stock in, well, your financial my financial projections say my company is going to do this. And they've seen this movie before. And they have certain objectives that they're trying to achieve. And so, does that make sense? Other questions?
Yes. So just correct me if I'm wrong. Does in the seed round, if I'm using convertible notes, does the valuation get determined or no?
Good question. So does everyone know what a convertible note is? So I didn't really delve into it in the interest of time, but the short answer is rather than selling stock directly, okay, sometimes investors, particularly angel investors, will, instead of buying shares, will quote unquote lend you the money with a convertible note. Now, even though it legally looks like a loan, they don't really ever expect to get paid back in the same way that a bank gets paid back when they lend you money. Rather, what happens is they invest in the note and hope and expect that it'll be converted into shares when someone else comes in and raises money, invests money at a subsequent priced round. Okay? The reason why they do that is it's quick and easy to raise money via a note. It's less legal expense, and they typically don't have to put down a hard valuation. However, right, however, there has to be some conversion formula. And so that is typically they'll put a cap on the note and I'll explain what that means in a second, and or a discount to converting it the subsequent round. So if you were to raise money at, let's say you raise your Series A a year from now at $10 million, and you had a capped note at a $5 million valuation, okay, that means that the money that they invested in the note would convert into shares at that $5 million cap rather than the $10 million valuation that the A went in. And it would usually be the the greater of the note or the cap, or the lower of the cap or the discount to that subsequent round.
Awesome. Thanks a lot. Could you please talk more about the dynamics of the NYU venture fund, for example, the vintage fund and the average check size?
So in terms of the dynamics, if by that you mean when do we invest? Or,
no, I'm like, for example, you mentioned what's the vintage fund? Like you mentioned, like it's a 10-year fund and you should be in this.
Oh, so ours
graph.
is an evergreen fund, so you don't have to worry about that. Meaning that we are always investing in new investments, so you don't have to worry about us. Okay, so that's one thing. I can explain more about that offline. But the second part of your question was average check size is $100,000. And so we will invest in a round with other angels or seed funds. We'll invest $100,000 typically as part of a larger $500,000 to $2 million round. So we're going to be a small investor as part of the larger syndicate.
Thank you so much.
You're welcome. Other questions?
So you mentioned the first question we should ask ourselves is when we should start raising funds, and how do you set up the runway for yourself, and do you have the regular time or regular circle for that? Let's say 6 months or
In
3
terms of
months?
the amount of time it takes to raise a round or the amount of time the money should last?
Yes, but in the beginning we don't know about those numbers. We only have assumptions. So how do you know when to start exactly? I mean, how do you answer this question? I mean,
Well, I think everyone is every situation is a little case specific.
right.
And so that's why I encourage you to engage with our team, and we'll try to help identify your specific situation and what your financing needs are and when we think you're kind of a few months away from being ready, so we can start to help introduce you to folks and have those conversations. But that being said, you know, if you start coming here, participating in coaching sessions, then you'll be eligible to do office hours, meet with VCs, and you can ask them yourself, or you can just go to events. All right, is this helpful? Great. Thank you.